Imagine you're on a flight where every seat is taken. If 200 people each paid $500 for their ticket, that's $100,000 in revenue for just a few hours in the air. It looks like a goldmine. But the global industry tells a different story. In 2024, airlines brought in nearly $1 trillion in revenue, yet collectively they walked away with a $5 billion loss. How can a business with record-breaking demand and packed planes struggle to stay in the black? If we take that $500 ticket and slice away every hidden cost the airline has to pay, we can see exactly where that money is disappearing. In this business, a full plane isn't a sign of success. It's just the starting line in a race to cover expenses that are higher than almost any other industry on Earth. The first major portion of your ticket pays for the people. Beyond the pilots and cabin crew, an airline relies on a massive team of specialized mechanics, baggage handlers, and dispatchers. This payroll consumes nearly a third of your fare before the plane even moves. Then there's the equipment itself. A single massive long-distance jet costs hundreds of millions of dollars to buy. To manage those staggering costs, airlines rarely buy their planes with cash. Instead, they rent about half of the aircraft currently flying around the world. This happens in two ways. Dry leasing is like a long-term car lease for the bare aircraft, while wet leasing is a short-term fix, where the airline rents the plane, the crew, and the maintenance as a complete package to help during busy months. This rental system allows airlines to grow without massive upfront debt, but it creates a permanent drain on their income. The leasing companies that own the planes often take 10 to 15% in profit from these rent payments, margins that are much higher than the airlines ever see. By the time an airline pays for its specialized staff and the rent on its planes, the majority of your ticket price has already been spent. Then there is fuel, the most unpredictable expense in the budget. Its price swings wildly based on geopolitical events that executives cannot influence. To survive, airlines use fuel hedging. They try to lock in fuel prices months or years in advance, essentially gambling that they can secure a lower rate before prices spike. But if flights are suddenly grounded, this strategy backfires. Airlines can find themselves stuck paying for fuel they don't need at rates that are much higher than the current market price. Delta tried a different path by buying an actual oil refinery. They hoped that producing their own fuel would protect them from market swings, but the complexity of running a refinery added its own set of financial burdens. Even the remaining few dollars of your ticket are taxed by partners who hold regional monopolies. Major airports charge high fees for every gate use, and the digital systems that handle your reservation take a cut of almost every sale. This pressure is worsened by unprofitable, state-funded airlines that refuse to close down, keeping prices low for everyone. Meanwhile, strict airport rules can force carriers to fly empty ghost flights just to keep their designated takeoff times. Airlines sit at the most vulnerable point in this chain, absorbing almost all of the massive operational risks, while the airports, software providers, and leasing companies take the guaranteed profits. If the basic math of flying people from city to city is so difficult, how do the most successful airlines manage to thrive? Some focus on volume, like Indigo. By flying only one type of airplane, they keep maintenance and training costs at rock bottom. They remove all the extras and rely on thousands of simple, short flights to make a profit. Others use sheer scale, like Emirates. By using large, long-haul aircraft and a single massive global hub, they capture high-paying international travelers and move massive amounts of cargo on every flight. Major U.S. carriers have shifted their focus toward income that doesn't depend on the flight itself. They sell loyalty points to credit card companies for billions of dollars, essentially acting as a currency distributor. This high-margin business often provides more stability and profit than the actual operation of the planes. Looking back at that $500 ticket, the amount the airline actually keeps from that specific seat is often close to zero. To survive in this industry, a company must move beyond just selling seats. They must transform into a diversified travel conglomerate, using loyalty programs and technical expertise to protect themselves from the brutal costs of the flight.